Alright, so we have to look at the next subject, which is equity investments. Now, equity has 3 study sessions to be covered: study session 10, 11, and 12. Study session 10 is a very short study session, has 2 small chapters on equity valuation and return concepts. I hope I'll be able to complete the study session literally by break time. So hopefully the first 2 chapters should be relatively simple, easy to cover. The very basic stuff, just talking about what is the concept of equity valuation and the different ways of calculating return and the different ways of calculating the components of cost of capital. So we talk about how to calculate the beta, how to calculate the risk premium. So a bit of practical application on the cost of capital. We will definitely venture into study session 11 as well, which is into industry and company analysis. And if we get some time, then we can probably also look at the valuation model, which is on the dividend discount model. So let's try and see how much we can cover. The equity chapter is a very large part of your level 2 content, minimum 3 case studies, but usually more than that. They have deleted a couple of chapters on equity this year. There were 2 more chapters in study session 11 that have been removed, so the content has been reduced for level 2 this year for equity. But they were not very substantial chapters anyway. They were mostly theoretical chapters which have been removed. The major chunk of the valuation part is in study session 12, all the valuation models for free cash flow to the firm, free cash flow to equity, multiples based, residual income valuation model, and private company valuation. So all of that in study session 12. So let's start out with the study session 10. As I said, simple, easy topic. The first part of this topic really talks about what is valuation, what are we really trying to do, and how are we going to do the valuation of a certain security. The concept of valuation is that we want to find out the true price that this stock should be at. Right? So we will find out what is the correct price that this stock should quote at. Now, what is the basic idea of valuation? I mean, if we were to believe that the markets were efficient, we would never have to do a valuation model. If the markets were efficient at all times, any valuation would simply give us the same number that the market already has. So the fact that we are starting out with this chapter, the fact that we even are reading about valuation, the fact that we want to do a valuation, we are already believing in it, believing in the fact that the markets are somewhat inefficient. The markets are unable to price the asset properly. So valuation in itself is questioning the market to quite an extent. And when you want to value any asset, or anything for that matter, you really want to find out what is the true price that somebody would tend to pay. And the true price would depend on the use of it, for example. Let's say, for example, anything that you buy as a consumer, you really want to associate a specific value with it. For example, in economics at level 1, we made the demand curve downward sloping, and we said that the demand curve reflects the maximum value that you derive from a product. And that value is something that was very subjective to everybody. And if you ascribed a higher value, you were willing to pay a higher price. If I ascribed a lesser value, I paid a lesser price. So you will also notice that valuation will be quite subjective to the purpose of the valuation as well. If I am valuing for investments, it might be different valuation. If I do a valuation for tax purposes, I might get a different value. If I do a valuation for legal purposes, it might be a different value. So valuation may also depend on the purpose of the valuation. It will also depend on the pocket of the buyer. The way I put it actually is, they say that beauty lies in the eye of the beholder. I say the valuation lies in the pocket of the buyer. Now, because if you're willing to pay for it, and if you are ready to ascribe that value, well, that's the value. Right? So the valuation depends on how you look at it. So while we are starting out this chapter, I want to put out a very simple point to you, that any valuation that we do in class here, or any valuation that you do at your Excel sheets, at your office, at any point of time, don't build emotional connection to your valuation. Why? Because most times what will happen is the transaction will never happen at that price. Valuation models are only made just to start out the negotiation process, to see what probably could be the right price. Mostly what happens is that any valuation model that's made is simply made to understand what possibly could the value be, but the ultimate transaction price of the asset really depends on the negotiating ability of the buyer and the seller, and what is the desire for each one of them to buy and sell. If let's say the buyer really wants to buy, he might pay a much higher value than what the Excel sheet gives, and vice versa. The seller is in dire need to sell and get out, well, he will sell it at distressed valuation. So my point is that valuation from the Excel sheet that you will do from the FCFF dividend discount model are only a starting point. The intention of this valuation model or any valuation model is not to say, oh, this is the value, this is how it should do it, and there is no other way to do it. This is only to tell you how you can think about valuation, or how you can think about starting your discussions, what are the variables that are important that you can negotiate on. So valuation, what is it? It's a process of estimating the true intrinsic value, and which we believe as fundamental analysts to be independent of the price. Because if it was not independent of the price, then the valuation would have price somewhere in the model itself. Or in fact, we will take the price as given as the value itself. So the value that we are trying to calculate is independent of the market price. So we are believing that the markets in the front itself are incorrect, or they are not able to ascribe the right value at most times. And how will we do that? Valuation will depend on primarily three things. Valuation for anything, any asset that you look at will depend on primarily three things that we look at. A, cash flows, the growth of those cash flows, and the risk of those cash flows. Three basic things. And the way I try to remember that, even though the model may be absolutely crappy, but the way I try to remember it, I remember the Gordon growth rate model. D1 upon K minus G. There are only three things that are on the right hand side of this equation. Value is equal to D1 upon K minus G. What three things? Dividends, cost, growth. You may not agree with the model. You may say that the model is incorrect. You may say that the company doesn't pay dividends. You may say whatever about the model. But the model at least tells you what are the three things that are important. And all of these valuation models will be dependent on the three basic components: A, the cash flows, the growth of those cash flows, and the risk of those cash flows. Right? That's what we're going to be. That's when we talk about fundamental valuation. That's what we're going to talk about. So the valuation of an asset. Valuation of asset does value does based on the fundamental variables affecting the future returns, comparison with similar assets, or estimates of immediate liquidation. So based on these 3 points, you will look at the method of valuation. The first method, it says valuation of future returns, discounted cash flow valuation, FCFF, FCFE, dividend discount model. Comparison with other assets, multiple based valuation models. Estimates of immediate liquidation proceeds, an asset-based valuation model, simply the assets on the balance sheet less the liabilities. The intrinsic value of an asset is the value given complete understanding of the investment characteristics. So you want to understand absolutely everything about it. That's why as a fundamental analyst, we want to read about absolutely everything. You want to read about the economics, the industry, the company, the financial statements, the management, the products, you name it and we want it. This is the actual value of the company or an asset based on the underlying perception of its true value, including all aspects of the business in both terms of both tangible and intangible factors. And if the market price was equal to this value that we prescribe, then the markets are efficient. And we will of course value this company on a basis of going concern. The going concern concept is the fact that we are going to expect the company to exist forever. Now, is that a valid assumption? Is that a valid assumption that the company will exist forever? Yeah? Do you think, or you think of examples that a company has existed for a long time? Long time. And if you can only name those examples and put them on your fingers, then you're talking about an exception to the rule and not a rule. If there are only a few companies which exist for a long time, then a going concern should not be my method of valuation. But having said that, let me qualify my statement. Let me put the statement in a true light. The most part of a valuation that you look at, let's say you were to discount your cash flows, A major part of the valuation comes from your terminal value. But if you think about it, that the cash flows happening 30 to 40 years later usually don't matter too much. Because by the time you discount those 30-year, 40-year cash flow to today, their value becomes really small. So when we say going concern, yes, of course, the valuation we are going to assume as if the company really exists for a very long time. Even if the company was to exist only to about 30 years and then shut down, the cash flows after the 30 years as of date to date don't matter as much. Of course, the valuation will dip, of course, if we say that the company is going to shut down after 30 years, but I'm just trying to say that think about a cash flow after 30 years discounted by 1 plus R is for 30, the value of that cash flow will be quite less today. But anyway, we can question this assumption right at the starting point, going concern, that companies don't really exist forever, but we are going to use that assumption, and therefore, because of this assumption, our valuation may always be on a slightly higher side.
So why this concept is there when we really going concern? So
then, because if we assume that the company is going to shut down, then the valuation methodology will change.
So, but there are no companies which exist for infinity going concern.
Yes. But I qualified my statements by saying that the cash flows beyond a certain date wouldn't matter too much. Because when you discount those cash flows, the value of that cash flow in the valuation part will be a very minuscule part. So therefore, this assumption becomes valid. And again, another point, the accounting statements have also been made with the same assumption. The minute we start assuming that a company is going to shut down at a certain stage, then the accounting, then the analysis, then the valuation will all change. Then the valuation methodology will be not discounted cash flows, will be more on a concept of, as we said, the liquidation value.
So,
yes.
So for valuation purposes, what is the general time frame that is being taken for the discounted cash flows?
That's a good question, and I will answer that question probably in the next study session, because that's a question that's been answered by the CFA Institute itself. In terms of how long should you forecast? Should you forecast for 3 years, 5 years, 10 years, 15 years? How long should you forecast for? That's a very valid question. We'll talk about that. So going concern, there is the assumption that the company will continue to operate as a business as opposed to going out of business. Our basis evaluation of a company too will be under the basic and a very important assumption that the company will continue to do business. And when a company, however, is expected to go out of business, the valuation is done on the basis of its liquidation. That is the value of the assets less the liabilities on a market value basis. An analyst's ongoing effort is to identify securities that are mispriced relative to their intrinsic value, where the market price is incorrect, and buy those securities whose value is larger but the market price is lesser, and sell those which is slightly overpriced. So basics of valuation. Now, when you do the valuation, what inputs would go into it? So I'm sure you have a basic idea about this. Let's discuss about it. What do you think are the inputs that go into valuation? Okay, cash flows, dividends, cost of equity, growth, earnings. Can I say all that in one word? Financial statements, yes, accounting statements. So, okay, let me ask you a question in a slightly different way. Where all would you look at? What all will you read? What all will you go through before you do your valuation? Financial statements, one. Okay, what else? Industry analysis, yes. Economic, all right. So you look at the broader picture of how things are performing. You look at the competitor framework. You look at other analysts, what they are saying, okay.
Treasury bonds.
You look at
Treasury bonds for the rate.
Interest rates in the market, so that was the economy at large, okay. What else?
Industry
has to be mentioned.
Laws of the country.
All right, so the political framework, the framework that we work in within that, okay, what else?
Future prospects.
Possible growth opportunities.
Intercompany analysis.
Yes, intercompany analysis, okay. So you haven't still specified the areas to look at. I mean, what documents to look at?
The income statement.
So one is annual report, right? So that's where you start with. If you're doing a valuation, you have to read the annual report. That's the company's statement to you as a shareholder, first thing. Then of course you will read the footnotes to the accounts. You will read all supplementary information, whatever filings that the company may have done. But what you've missed out is completely, you've only looked at the quantitative part here.
Management.
A major part of your valuation is something that is qualitative. Do you believe what the management is saying?
Audit reports.
Maybe the audit report. Do you believe their numbers? Do you believe their accounting policies? Do you believe on their footnotes, etc.? Is there anything majorly incorrect? Because if a company is doing a fraud, for example, on reporting wrong numbers, your valuation is absolutely crappy too. So there are two very important inputs that you're looking at. Is A, the qualitative side of the inputs, where you want to understand the earnings quality. Earnings quality refers to how reliable are the numbers? How reliable do you think are the numbers and the data that the company is providing you with? You will look at news reports. You will look at competitor analysis. Yes. So the quantitative input, we all know, use all information available about the economy, industry, firms to estimate the earnings, margins, sales, leverage, asset utilization. But more importantly, frankly, earnings quality, management ability to deliver on the results, and the transparency on the information to the shareholders. The second part of the data set is actually more important than the first part. Because mandatorily, every company will provide you information. But how transparent are those numbers? What are their accounting practices? Do you believe on what they're saying? And does the management have a good ability to deliver the results? That's the point. I mean, that's a very qualitative assessment, and you can't really put a number to that and say, oh, this is the case. And that is exactly the reason why you think it's a buy and I think it's a sell. Why there's a difference of opinion. Because if the numbers are the same, then the valuation model will be the same. If all of us are doing the same valuation model, same Excel sheet, we should get the same number as well. We should be able to predict the same thing, and if it's the same number for everybody, the market price also should be the same as that. Is a difference in the qualitative aspect that I'm wanting to point out. So, the qualitative aspects is something that you will get once you start asking the right questions. You have to understand that if you're working as a valuation analyst, if you're working as a research analyst, your work is that of an investigator. You're like Sherlock Holmes. You have to investigate the company big time. And you have to make sure you ask the management questions which probably they don't want to answer. Not insider data, but probably the tough questions that they have hidden information around in terms of the accounting statement, they haven't disclosed them. So try and find out possible things, that where is the information hidden? Where possibly could they have misguided the people? So you need, because see, remember, they are in front of providing all the information, so you have to decipher what possibly could go wrong in the data set. So you have to ask questions then, right? So qualitative inputs, earnings quality, management ability to deliver the result, transparency, and accounting practices. The building blocks for equity valuation is this accounting information contained in the firm's reports and releases. Earnings quality raises the issue of disclosed information and its accuracy. It requires examination of the firm's statements and notes to the accounts as well. And it's definitely been found that greater transparency of data provided by the company, the risk perceived by the shareholders is lesser, and therefore the valuation of the company is higher. If you look at various companies, I'll give you an example. Some of the IT companies, they provide a lot of data to their shareholders. The idea of providing a lot of data to the shareholders itself is indicating transparency. You know why? Let's say if I were to give you a wrong piece of information, I would give you very little information. I would not allow you to look at a lot of data set in my company, because what will happen is that hiding something becomes very difficult if I open up all the information Pandora box to you. But companies which are open and provide every possible data set to their shareholders usually are not hiding things. So the transparency that a company has, it makes the shareholders believe the data set more, and therefore the valuation is more because the perceived risk on the data is lesser. Importance of the footnotes. Financial footnotes reveals management discretion in the choice of accounting methods and estimates. an acceleration of premature recognition of income, classification of infrequent items as operating items can really jack up or decrease the earnings, which is not an acceptable point, of course. And the ability of the analyst greatly depends on all this data set. If the data set itself is incorrect, it will all be garbage in, garbage out. Your Excel sheet will not help you out. So, valuation doesn't happen on the Excel sheet. Valuation happens by your analysis, your understanding of the company, the business, the competitive framework, and a very important aspect, something called a sustainable competitive edge. We'll talk about that a little more as we go along, but yes, the company's valuation depends on, does the company have something unique that they are able to sell the product on and on and on to their customers, and the customers keep buying the same thing, or maybe an improved thing. So, will the customer keep coming back to them? So basic stuff in terms of valuation, but very important stuff. This is very relevant from the perspective of, because a lot of you might be working at some point of time and doing a valuation model at some point of time in your careers. So you need to know all of this very, very importantly, that don't just look at the numbers and believe the numbers. Dig down deeper, ask questions. Why do we do valuation? What are the uses of this valuation? It's not just to simply buy and sell stocks or simply to find undervalued, overvalued stocks. We do valuation for that purpose mostly as an analyst, but there are other purposes too. So valuation may be done for stock selection, to buy, hold or sell a stock, to infer inputs from the market and versus history. So if I want to find out what is the implied growth rate or the implied cost of capital or the implied volatility, I might have to do a valuation model. So I can infer from the market as to what is the market inferring or what is the market trying to think. So what is the growth rate or the discount rate the market is applying to the stock based on the valuation model being used. Projecting value of corporate decisions such as mergers and acquisitions. So the entire chapter of corporate finance M&A was based on the concept of valuation. So in case of mergers and acquisitions as well, you were looking at valuation models to decide whether a merger is fair or not, whether a merger will create synergies or not. So I had left a major chunk of the valuation part there, but I'm going to try and cover that in the next couple of classes here. So trying to understand whether mergers or acquisitions or MBOs make sense. Do you remember one of the takeover defenses that we had talked about, rendering a fairness opinion? There was one of the takeover defense that the company had was to ask an independent third party to issue a fair opinion as to what is the correct value of this company. So you as an independent accountant or an independent analyst might have to issue a report and say that, oh, what do you think the value of this company to be? So rendering fairness opinions in events such as M&A, what is the fair price for the minority shareholders? Evaluating business strategies and models, how to maximize shareholder wealth. Again, valuation, again, discounted cash flow is what you look at. Common basis to discuss and evaluate company's performance and to decide whether the management of the company deserve a higher salary or not. So has the company performed better or not? So again, a concept of valuation will come in. Valuing private businesses. Why would we want to value a private business? What would be the reason to value a private company? Takeovers, again, so alright, so you might have an M&A or a merger or an acquisition. What else?
Intention to go public.
Listing, the company is expected to be listed, so what price the asset should be listed on the stock market? What else?
Private investments. Private equity.
Same thing. What else? So either it may be an investment purpose through a public equity or private side. What else? Why else would you value a private company?
Which is a better investment to judge?
Same thing, investment that I want to check for investment purposes. So valuation is done for investment purpose, but would you value for any other purpose besides investment? Statutory and legal purposes. There might be a legal issue of where the company has maybe given ESOPs to their employees and the ESOPs valuation needs to be done. So a legal purpose, was that done in a proper manner or not? So lawyers do valuations, do you know that? Which are prescribed by the court methods. Accountants do valuation for tax purposes, for deciding what is the correct tax treatment for this how much tax should be applied. So valuation is not only done for the purpose of investment, it may be done for the purpose of applying the right tax or for legal purposes too. And the valuation methodologies for those purposes are actually very different, and we don't even read about them actually. I'll tell you an example. I once saw a lawyer doing a valuation. I said, what the hell? This is completely incorrect. But he said, this is how the court accepts it. The court says the valuation be done in this manner. So the valuation techniques of lawyers and certain accountants or even for tax purposes may be very different and unique as compared to what we are reading about. We are focused on one part of it, which is on the investment side. But that the valuation not only used for that purpose, no. So private company valuation, and you also value for the purpose of portfolio management, valuation of potential investments, which guides the implementation of investment plan and the execution of that plan. So there are various reasons why you value a company. Not just investments, but yes, there are other reasons too. And when you're doing an equity valuation, as I said at the beginning itself of the class, I said you are already thinking or you already have in mind that the company's price in the market is not correct. That's why you're valuing. And when you're valuing, you try to ascribe a value called as intrinsic value. Is this intrinsic value an observable number or an unobservable number? You can't ever see it. In fact, you will never find out whether this was the right number or not. So you write a valuation report, you tried your best stuff, you did the best that you could to write a valuation report, but I'm sorry, you could be wrong. Because you're trying to estimate a number that you will never be able to see. So you call a stock to be under or overvalued, but maybe the stock is not over or undervalued. Because the actual value is unobservable. So the analyst's estimate of intrinsic value minus the price has two components to it. What you call as under or overvaluation, there are two components to that. So say for example, let's put a number. Let's say the current market price of an asset, the price of an asset, let's say is 100. But you say that the value of the asset is actually 140. So you put a value of 140 and say that the current market price is too low. Whereas actually, so this is the valuation of the analyst. The value, the true value that it should be is, let's say, 90. The true value, which is an unobservable number which you can't see, which you can't ever find out. So what you see as the difference has two components in it. One, the mistake that you are making, and the other, the actual difference. For example, here the actual difference between the value and the price is this. But the mistake that you are making is this. The actual difference is 10 rupees on the negative, that the stock is overpriced. However, you have overestimated the value by 50 rupees. So, the point being that your differential of the analyst price and the intrinsic value has two parts. The actual difference in the valuation and price and your mistake. The mistake that you are making in your valuation report, which you don't even know that you're making it. Because this is something that you can probably look at in hindsight, but never at foresight. And a good analyst is one who tries to think about it, how on a foresight can I reduce it as time passes by. That is, yes, I know I will make mistakes. About a person who does valuation reports or who does any buying or selling of stocks has to have in mind that he cannot find every undervalued stock and buy it and sell every overvalued stock. And even if he does, he'll be wrong most of the time. Not most of the time, but he will be wrong sometimes at least. A good analyst or a good portfolio manager, somebody who I could say is like the top quartile, top 25% of the portfolio managers across the world. What percentage of the calls do you think will they get right?
65%.
So I'll repeat my question. What percentage of the calls in terms of buy and sell, what percentage of the calls do you think the top quartile of the portfolio managers and analysts will get right?
70%.
So let's give you a perspective. If I were to ask a monkey to write a report and say buy or sell, he'll be right 50% of the times. Because there are only two options, either buy it or sell it. Yes? Yeah, but you hardly do that report. So it's a buy or a sell mostly. So as a random case as well, you are 50% of the times right. Now, the person who is at the top quartile, That means top 25% of the managers who are really good, performing really well. What percentage of the calls do you think they get right on an average?
70, 60%.
Do you think it will be 90-95% times?
No.
What number would you write?
Around 70.
It's about 65-70%. Which is what you need in your CFA exam too. Yeah, you don't have to be 100% right. If you're right 65-70% of times, you are really a star analyst. I'm not kidding on that. Have a look at any top performer across the lines on any field. Pick any field, any area. Look at the top 10% of the performers or top 25% of the performers. Look at their success ratio. Do they win every match? Look at teams rank at number 1. Look at players rank at number 1. Do they win every match? Of course not. Their wins ratio are approximately about 70%. So they're slightly better than the average from 50, which is like a random case, to about 70. Right? So 70% correct calls, you're great. So yes, we are leaving margin for error. We are saying yes, you could be wrong. So accept that. So accept the fact that yes, we could be wrong. Yes, we could go completely haywire. Yes, we could possibly buy stocks with complete conviction and the company goes bankrupt. Literally all successful investors may have had 1 or 2 calls like that for sure. At least minimum on that. So the point being that there will possibly be mistakes on certain valuation that you will do because you can't truly see what the correct price is. Now, having said that, when you do valuation, there are 5 steps to it that you should look at. And while I'm referencing to this, I would also want you to look at your CFA books. In the first chapter of your CFA book in equity, they have provided you a format of how to write an equity research report. Very often what happens is, at your interviews at companies, when you go for an interview or a, let's say, a possible job situation, they ask you to say that, okay, we give you a hypothetical company or company ABC, write a report and tell us what you think. That's a very normal method of screening candidates. And at that point of time, the first question that comes out is, how do I write it? What do I have to write? So if you are being explained that at this stage itself, so if you're at your CFA level 2 equity book, they provide you a basic format of how you should write an equity research report. And I'll give you a point of hard truth here. You can take, let's say, about 2 weeks, 3 weeks to write an equity research report. You might take as long to write it. How long do you think will your portfolio manager spend time on reading it?
5 seconds.
You'll be very lucky if he spends more than 5 minutes. You'll be terribly lucky if he spends more than 5 minutes. That is, he will read the first page, and if he finds the first few lines interesting, great. Otherwise, it goes into the trash bin. Because he probably knows already what you're saying. So my point is, when you're writing a valuation report, the formats are very different. You write your conclusions first. You write your punchline, the reasons for buy, sell up front. And then you maybe explain why the company may be a buy or a sell. Then you explain, then you justify your reasons. So your conclusions are right up front. So it's unlike the normal report where you write a summary in the end. There's a summary up front and you write it as short bullet points so that it is very, very clear. He doesn't have to spend time on reading it. It should be quick. So you have very little time with the portfolio manager in hand. You should make his time as valuable as possible. So when you're writing a research report, when you're doing a valuation, there are 4 or 5 things that you look at. I'll read them out. A, understanding the business, industry and competitive analysis together with the company disclosures. Forecasting the company performance either through a top-down or a bottoms-up approach, which is forecasting sales, profitability and financial situation. Selecting the appropriate valuation model, which is to decide how to do the valuation correctly. Should I use a DCF, relative valuation? Within DCF, should I look at FCF or FCFE? Which valuation model is right? Converting the forecast into a valuation and applying the valuation conclusion to decide whether it's a buy or a sell. Now, out of these 5 steps, which one do you think is the most important? There are the 5 steps that I've listed down here. which one do you think is the most important step in your valuation model? Doing the second, forecasting company performance, you will mostly be wrong. Even if you had all the possible data, even if you were the CEO of the company, you will most probably get the numbers wrong. So forecasting, you might get the numbers right or wrong. Well, you're an analyst, you don't have inside data, so as a public data, you're forecasting, even if the direction of the forecast are right, brilliant. That's a great thing. Selecting appropriate valuation model, yes, you could possibly do that if you understand the dynamics of the valuation model. That should not be a very, very hard thing to do. Converting forecast into valuation is a thing that we learned here as a quantitative method, and the fifth one also is relatively straightforward. But the main and the crux of the valuation that really depends on as to decide how you will perceive things is the first step. Understanding the business, and spend ample time in doing that. I'll tell you a very common mistake that most candidates make when they write a valuation report or when they do a research. They straight away jump to the financial statements and start making and putting it on the Excel sheet. That's the first step. They look at, oh, let's say accounting profit and project your cash flows, etc. That's the first step that most people look at. Take a step back, understand how does the company create business, how are they creating value to their customers, will the customers keep coming back or not? What is the kind of product that they're selling, what are the risks that they are facing? Understanding the business is your core competency in terms of understanding doing your valuation. That's the first step, and we'll spend some time doing that itself here in terms of how you could possibly do that. This is not the only method to do it. We will try to put a practical application part here in terms of how possibly could you do it. So understanding the business. One method that your CFA Institute prescribes is they say do the Porter's 5-factor analysis. You've read briefly the Porter's 5 factors at level 1 as well. The Porter's 5 factors tell you that there are 5 factors that decide the long-term profitability, the growth and the risk of the industry and therefore the firm. 5 factors being industry and company analysis. What is the rivalry within the firms? How badly does everyone in the market, in that industry, want to be number one? What is the kind of competition that they have? Does everybody have does this industry have a cutthroat competition of trying to get the customer? Because if that's the case, they will fight for every customer, and fighting for every customer means that the customer will win and they will lose every single time, because the winner's curse will come in. They will bid and bid to the extent that they are on the margins all the time. So how intense is the rivalry among the firms, and what are the aspiration levels? What are the aspirations of the people in this industry? Do they really want to be number one? Do they really want to take over the entire industry, and how do they want to work it? Because when you read the management reports, you will understand the psychology behind the managers. How are they thinking about the company? And how intense is the rivalry? Bargaining power of suppliers. Has the company standardized their inputs, or do they get customized inputs from some people? Because if you standardize your inputs, then you can have a bargaining power from buying from lots of different people. Give you an example. Companies like Maruti, or for that matter, let's say Tata Motors, you know what they do? They standardize their cars and their inputs, and they say we will buy from various dealers, various auto component providers. They don't buy from only one party. You know why? Because, of course, then the bargaining power of that one person becomes very large. So they do a tender and say, we will ask you to give us the best possible prices. So they make those people compete by standardizing the inputs. But if you start asking for customized inputs of doing specific customization for your purpose for every specific car, then it will be very difficult for you to negotiate. So we'll talk about that point further in some way. But bargaining power of suppliers, if the suppliers are powerful, they will extract the major part of the value from the industry. They will make more money than you do. Buyers, what is their bargaining power? If you are supplying to few buyers, then they can make you compete. For example, there are certain companies in India which make railway wagons. They make railway wagons and they sell these railway wagons only to the Indian Railways. Now the Indian Railways decides who would I want to buy it from. So they have the bargaining power in that case. Therefore, at any stage, if these companies start making too much money, the buyer will say, cut down the prices, I'm not buying from you. Right? So the point is their bargaining power can be substantial if there are a few buyers in the industry. Substitutes. Your product, does it really different from anything else that is the market has? I mean, and you need to look at really out of the box thinking from here. That quite often there will be certain products that come into the market that you couldn't even imagine that they will replace your product's demand. For example, think about it. Let's say, take an example. Let's say if I was selling, let's say, for example, watches, or if I was selling, let's say, cameras, point and shoot cameras, I could have never imagined at certain stage that I would get replaced as an industry, I would get replaced by a mobile phone. Because today nobody buys a point and shoot camera. Right? Nobody buys that. If you were to buy a camera, you would buy actually a DSLR camera. Right? You would buy a professional camera, but because most of you anyway have the camera on your phone. So separate point and shoot industry is finished. Why? Because you had to imagine that yes, there is a certain industry that's building up that will completely replace you. So you have to devise strategies upfront that are there substitutes available in the market that will completely wipe you out. So set of possible substitute products. And it is possible that the industry might have built a certain sense of understanding between competition, but a new entrant can possibly destroy that completely. And the easy example of understanding that is, think about it, that at some point of time the telecom companies in India, they had their pricing all set very easily and all companies had accepted that set of pricing, which is they were all pricing per minute. Almost about 7-8 years back, the pricing for all companies was a certain rupees or a certain paisas per minute. They were all pricing and said that, okay, whether you call for 5 seconds or 20 seconds or 30 seconds, we will charge you per the minute. One company came in and said, to hell with all of you, your understanding doesn't work, I will charge you 1 paisa per second or 2 paisa per second. Whatever the pricing, but he changed the dynamics of pricing. Now that changed the dynamics of the industry quite an extent, and the companies had to adapt very quickly or lose customers. So a potential entrant can change the dynamics of the industry completely. So you have to be aware and be prepared for that too. So Porter's 5 factors. Within industry, a company's market share is indicative of its relative competitiveness. In general, greater sustainable competitive advantage of a company, greater its value. So I'm using a few very critical words. Sustainable, competitive, advantage. What is sustainable competitive advantage? Something that you do differently, unique, and it is hard or tough or impossible to copy it. And customers will continue to love it. So sustainable, that your product is unique and you do it so differently that your customers continue to come back again and again and again. How tough is that? That's terribly tough. That's terribly tough for any company to have because patents expire. Or for that matter, the competitive edge of a company goes away because they get complacent. A new idea comes in a garage or somewhere where this company is unable to even think about. So you have to be at the edge and always thinking about how can I improve. So sustainable competitive edge for a certain company. And that will define whether the company is able to generate a high ROE for its shareholders year on year on year. So something unique about the company. You have to identify that. For example, a company like, let's say, Maruti, their sustainable competitive edge for years and decades together has been the mass reach that they have built up across the country, where every mechanic can now work on a Maruti car. Right? Their reach is so big that they're able to provide service to the customers at the last end. Now that's tough to match. And customers buy this car for that purpose. Yes? So, sustainable competitive edge. How long would it take for another player to replicate it? Or take over that? Or will the company lose or become complacent about it? So, a couple of these points are very important here. The Porter's three generic strategies to achieve the above average performance. So, how can a company create above average performance? Well, being either a cost leader. Cost leader means that you are cheaper in terms of producing the product and you are better at it on and on. For example, at one point of time, Tata Steel used to be the lowest cost manufacturer for steel across the world. They had the ability somehow that they could manufacture this product at the lowest cost possible. But there was another company that came across and was able to replace them. It was Jindal Steel. Jindal Steel did something different. You know what they did? They did a backward integration. They did a backward integration of acquiring a mine, having an in-house mine to be able to get the ore and do it at a far cheaper cost than anybody else. So if you want to procure the product at the cheapest possible rate, it was now them. So if you're a cost leader, it will be very important for you to ensure that your leadership keeps getting maintained. For example, in case of the international framework, you could talk about cost leadership from a perspective of, let's say, China. China has maintained its cost leadership on the manufacturing facilities on and on and on. They are able to produce the products at the cheapest possible rate across the world without anybody being able to match it, and of course at that kind of scale as well. So cost leadership, lowest cost producer and priced at or near industry average. Second, the product that you manufacture is different, is unique. It's completely different and the customers pay for the uniqueness. Example. Okay. Apple is not meant for everybody, so it's meant only for a unique set of customers. Alright, fair enough. They provide a unique service. Fair enough.
Ferrari.
Okay, so Ferrari, yes. Yes, you don't buy a Ferrari because it's low cost. You don't buy a BMW because it's low cost. It provides you the uniqueness of having a very unique or a different facility or a car. So differentiation, that is unique product and premium prices. There's another company, I can't recall the name right now, but there is this guy who is into manufacturing of cars, into rockets, into Virgin and another one.
Elon Musk.
Yes, Tesla. Tesla. Yes, absolutely. Now, that's differentiation. The cars that he manufactures, or the cars that this company manufactures, or the things that they manufacture are different from every other manufacturer across the world. They're looking at solar power, they're looking at renewable cars, and so on and so forth. This is different. They say our stuff doesn't run on the normal stuff. So you pay for being different there. Focus on a particular target segment with a competitive edge within the segment through focus on cost or differentiation. So in the third strategy, you are slightly more, you have a narrower focus on certain specific segment of the market. You're not a completely differentiation focus, which probably Tesla would be, but a focus on a particular segment, let's say an automobile sector, on a specific segment, let's say segment A, you have a cost focus or a differentiation focus there. So, Porter's three strategies. Analysis of financial information. When you look at financial data, you look at ratio analysis, you look at various kinds of ratios. You look at various kinds of ratios across, you look at profitability ratios, turnover ratios, and so on and so forth. Do all of that. Consider the quality of earnings and non-recurring items and events. Non-recurring items. Give me an example of that. Non-recurring or items which are not related to the core business that get shown on the profit and loss statement quite often.
Insurance proceeds.
Okay.
Some provisions that you probably added.
Provision for good or bad for doubt debts. Okay, fair enough. What else? Yeah, but these are one time. In certain businesses, there are these non-recurring items which get repeated every year.
Sale of assets.
Give an example. Give an example of this. Let's take a case, a number which is very hard to predict and a number which is very difficult to look for banks. Now banks hold very large number of bonds, right? Assets are mostly their bonds. Now their bonds are classified into three categories. You know that as per accounting, held for trading, maturity and all that. Yes, available for sale, etc. For the trading securities, their gains and losses are for trading securities, their gains and losses are put onto the profit loss statements. And the trading securities gains and losses is actually shown as a core item of their profit and loss statement. But this is not really the core business of a bank. What is the core business of a bank? Lending and fees. That's the core business. Yes, maybe wealth management too. But their core business is not to trade on bonds. And this is an item which is highly volatile too. So in certain years you may make money, certain years you may completely lose money at this number. So the treasury department here may win or lose money. This is a very difficult number to predict. So a lot of banks use this number for a balancing figure for their earnings. Because what happens is they're able to, the other part of the banks didn't want to work, they try to jack up the earnings here by trying to book gains or losses here. So non-recurring items you should be familiar with what your industry has as a norm. If growth of assets is larger than growth of sales, what would you think? Just think for a second. The company is buying more and more assets, but the revenue isn't growing. What may be the logic of that?
The assets aren't performing.
The assets aren't performing. The assets aren't productive enough. You're buying stuff which is probably not worthy of adding value to the company. For example, you bought 5 expensive cars for the directors. That's an asset that the company owns. But that asset is not a productive asset. It's not adding value to the company to generate more revenue. So, if the growth of assets is larger than the growth of sales, it implies that the company is not using the assets as aggressively as they should. Compare trends with the company's net income and operating cash flow. Ideally, the two should go hand in hand. Income as an accounting number, cash flow should ideally be in hand. That is, yes, there may be certain years where they may mismatch, but the trend of growth, the trend of direction of these two numbers ideally should be in the same. Forecasting company performance, the second step. Consider both economic environment of the company and the company's own operating financial characteristics. And use always two forecasting approaches. One is top-down and bottoms-up. We'll talk both of them in one of the following chapters. Analysts combine industry and company analysis with your financial statement analysis to forecast your certain items. So you combine what you have learned at step 1, industry analysis, into step 2, how to forecast. What do you think will happen? So it's very difficult to forecast. It's very difficult to forecast, but yes, if you have done your step 1 reasonably well, you may have a sense of direction at which way the company's valuation and numbers may at least move. So, my point that try and spend as much time as possible at step 1 in understanding the kind of product that the company sells and whether the demand of this product will be sustainable or not. Step 3, deciding on the valuation model. If the company is a going concern, use either an absolute or a relative valuation model, or else use the liquidation value. The absolute valuation model that we look at, there are two sets of valuation models, absolute and relative. Absolute valuation models, names, discounted cash flows. Discounted cash flows, dividend discount model, FCFF, FCFE, discount the cash flows today and get the valuation. Residual income valuation model. Absolute valuation model means that the value of the company here is independent of its peers, independent of the industry. We are valuing the company as the company is without looking at the comparables. Absolute valuation. So that is discounted cash flow, relative valuation. And within the absolute valuation, you talked about cash flow, dividend discount, FCFA, FCFE. Relative valuation, we'll talk about the residual income valuation in some time. The third valuation model, which falls within this, is the asset-based valuation model. When would you use an asset-based valuation of a company? Is that the only time would you use it? Is that the only time would you use a valuation of an absolute valuation of asset-based valuation that is in liquidation, or is there another stage? When the assets are clearly visible and that's the true value of the business, for example. Okay, for example, a mining company, think about it. A mining company, for example, or a real estate company, where the valuation is as per what they own, let's say land bank. For example, a lot of analysts value DLF and Unitech as per land bank, as to how much land do they own, what is the price of the land. Or a mining company, let's say Coal India, you would value Coal India based on the amount of coal that they can extract from the mines that they have. That's it. Of course, subtract out the liabilities to get the equity valuation, but that's their main core asset. So you value on the basis of asset-based valuation, not only at the time of liquidation, but also when the company has tangible core assets which drive the main business. That's the core business of the company. So estimate the asset's intrinsic value, that is its value arising from its investment characteristics without regard to the other value of the funds. This may be calculated as discounted or present value of the cash flows expected in the future. The cash flows could be either in the form of dividends, free cash flow, or a residual income approach. Absolute valuation can also be based on assets, that is the sum of the market value assets owned by the company. This is frequently used for natural resource companies, for oil fields for example, for coal, for real estate companies. So you should be aware of the kind of valuation model that should be used in the kind of business that you are looking at. Relative valuation models. Value here is based on the concept of law of one price. The value here is based on the concept of law of one price, which states that similar assets should have similar price. Similar assets should be priced similarly. So value of an asset is in relation to the value of other comparable assets based on the law of one price, where the analyst says that the companies have similar growth, similar cash flow, similar future, their price today should also be similar. Choice of the valuation model is to be based on the characteristics of the company, the quality and the data available and their purpose of analysis. Let me give you a good example of this one. What does a mutual fund do? What does the mutual fund manager do? What is his objective?
Allocate the funds for
So what does he do? Let's think about you're a portfolio manager for a mutual fund. What do?
find the right investment.
You collect